Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets in April 2023. After the failure of Silicon Valley Bank, Signature Bank, Credit Suisse in the month of March, much of April was actually pretty calm, and we enjoyed okay economic data, but there is still this darkness percolating underneath the surface, manifesting itself in some problems with the US regional banking system. Since then, we've had the failure of the First Republic Bank. We are now moving straight through into problems with Pacific Western. Western Alliance has been rumoured. We are going to continue to hear problems in this space, which is causing the market anxiety. And the reason being is that the banking model, a fractional banking model, just simply doesn't work with the Federal Reserve funds rate set so high and such a deeply inverted yield curve where longer dated rates where banks are making loans are clearly much, much lower in yield. This is going to become a problem because it's these regional banks that are the lifeblood of the US economy. They are lending to small and medium-sized businesses. They are lending to commercial real estate borrowers. And all of these types of credit availability are clearly drying up very quickly in the United States at the moment. And that is the cause for quite some concern because at the moment they are individual issues, but there does become a point where they do have a network effect. And we need to think very carefully through that. The Federal Reserve and many central banks around the world are now in a position where they're getting quite caught between a rock and a hard place. They need to continue to finish off their hiking cycle programs to slay the inflation monster, to really make sure that inflation is put to bed once and for all as best they can. But the issue is that we've now hit this point where we're causing second and third derivative implications to markets and to the economy that are quite unwelcomed and are requiring massive bailouts or government programs. We are bending and breaking the rules very, very quickly through this. I think after the COVID experience, we all know that those rules can be bent very quickly. And we're certainly seeing that with the way that some of these deals are thrown together at the 11th hour over weekends to essentially hive out these institutions, move them into stronger hands, and try and carry on and hope that that's the end of it. The problem is it's just not the end of it. These bodies are going to continue to float to the surface because the ice that we're all standing on is sufficiently thin now. We are into very restrictive interest rate territory, and that means that for all of us, economies are going to slow down, and there is obviously a delinquency element to that, but we're getting much closer to where that does kick in. Unsurprisingly, bonds have been doing very well over the course of this year as we've enjoyed a much more disinflationary environment. But the easiest part of that settlement in inflation is probably behind us now. That doesn't mean inflation won't move lower, but it's not going to move lower quickly because of the base effect that we've talked about in many previous videos and presentations. So from here on, it does get harder, and we're going to walk a very, very fine line between central bankers wanting to keep rates higher and to slow economies and to bring that inflationary balance back into equilibrium, but having these issues which might garner material policy response, but they are terrified about reigniting inflation by cutting rates or, dare say, doing QE or any of these programs. Domestically, the Australian economy continues to do pretty well. A little bit to our surprise, we would have expected it would have slowed more by now. We are enjoying huge amounts of immigration again, which clearly is bringing a lot of workers into the country. It will help us keep our wages under control, more so than we've seen in other jurisdictions. But the RBA, classic flip-flopping between being very dovish, being very hawkish, being dovish, being hawkish, have re-hiked interest rates at the very start of the month of May, which was a surprise to us. I don't think that you should get too caught up in the terminal rate discussion, other than to look at the big picture of we are in very restrictive settings now. Almost certainly, as we go around the world, we're very close to the end, if not at the end, of hiking cycles, jurisdiction by jurisdiction. And markets are pricing in quite substantial interest rate cuts towards the end of the year in expectation of those slowdowns. So that should see fixed income continue to do fairly well over the balance of 23. And certainly from an asset relative point of view, high quality fixed income should do very well as opposed to things that are of lower quality or of lower liquidity. Thank you very much.